Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. Today's episode is dedicated to people who have just retired or are about to retire. That's a difficult proposition right now because it looks like if you're retiring in the very near future or retired already, you are retiring into the teeth of a difficult market, a market which is being gyrated by President Trump changing the global economy in significant ways, and into a stock market that looks overpriced regardless of what President Trump is doing. And so I want to take my bearings from an article that Morningstar's personal finance expert Christine Benz wrote on Monday, April 14th. Christine's a former colleague, and she made a number of good points in this article regarding what current retirees should do in this market. And the first one is assess your spending rate. Christine takes her bearings in the article from the idea of sequence of return risk, which we've gone over a few times in this podcast. It basically means a portfolio that's distributing assets to its owner can be damaged by a falling stock market in its early years. When the stock market falls and when you take distributions, the portfolio's bleeding on two levels, and then when the market finally recovers because you've distributed a fair amount of assets, you don't give the portfolio an opportunity to fully recover because it doesn't have the same amount of assets that it used to because you've spent some of the assets. So bear markets in the early years of retirement can really hurt a portfolio badly. So assess your spending rate. Consider spending a lower amount than you might have anticipated when you first went into retirement to protect yourself against a market that's falling. That's the first piece of advice. The second is a variation of Christine's concept of the bucket approach. Divide your assets up into different buckets, different accounts. Money you're going to spend soon, leave in cash or cash equivalent types of instruments. Then you can have another bucket with an intermediate term allocation, which might be something like a balanced allocation. And then you have a third bucket, and there are no limits to the amount of buckets you can have, but you can have a third bucket, which is longer term assets that are more aggressively invested. So pull your cash, your current cash that you're going to spend from the safest bucket, and that'll ease the psychological pain of watching part of your money decline in a bear market, and that'll be the longest bucket, of course, which is most aggressively invested. Another piece of advice, play the long game with Social Security. This means take Social Security as late as possible because you'll increase your payout. The earlier you take Social Security, the lower your payout is because, of course, the Social Security Administration is paying you for a longer period of time. Next piece of advice is revisit inflation protection. And I really like this one a lot. Christine talks about investing in Treasury inflation-protected securities or TIPS bonds, and we've talked about those in the previous episode with Brett Ahrens. Treasury inflation-protected bonds right now happen to be trading at what I think and what Brett thinks are attractive valuations or prices. They are tied to CPI. They track the consumer price index. That's their inflation protection. But the other thing is they happen to be trading in a way now that they're giving you something on top of that inflation protection. In some cases, if they're longer maturity, over 2%. So if you buy one of these bonds, you're getting a U.S. Treasury guarantee of inflation protection plus 2 or something more than 2%. That's attractive. I'll say something provocative here. I won't make any guarantees, but it occurs to me that Treasury inflation-protected bonds could beat the S&P 500 over the next 5 to 10 years. No guarantees there, but I think it's possible. So keep that in mind. Keep these assets to the extent that you own them in an IRA as well. They are not great assets to own in taxable accounts. Consult with your advisor about where you should own them. Another piece of advice, investigate tax-saving strategies, and that means possibly converting a traditional IRA to a Roth early in retirement. You may be in a lower tax bracket because you do take a tax hit when you do that conversion, but now you can do that, and you're not taking mandatory distributions yet, which could put you in a higher bracket later in retirement. So early retirement could be a good time to do a conversion to a Roth IRA with part of your traditional IRA or 401k assets. And the last part of that section, investigate tax saving strategies, is In a taxable account, just do some tax loss harvesting. If you have something with a loss, sell it, book the loss for your taxes, and reinvest the proceeds in something else that you think is appropriate for you. I have one quibble, as much as Christine is an excellent personal finance columnist. In the first section where she discusses assess your spending rate, she also mentions that you should check your asset allocation. It may not be appropriate for you. And I think Christine doesn't quite emphasize that enough. This is something that I've talked about before. I see many people on the cusp of retirement too aggressively invested in stocks. The amount of stock exposure you have early in retirement and when you're about to retire could vary. I don't want to be so rigid about this to say that it should be the same for everyone. If you have 10 or 15 or $20 million and a lot of that money is not necessary for generating income for you in retirement, but maybe earmarked for children or grandchildren, you are investing that money for the long term, longer than you'll be alive. And so it's totally fine to have an aggressive overall allocation if you're in that position. But if you have $1 million saved for retirement and you're counting on that money to generate $40,000 or $50,000 worth of income your first year of retirement, and adjusting that for inflation in subsequent years. In other words, using something like the Bengen rule, the 4 or 5% rule. We've also had Bill Bengen on this podcast. If that's your situation, then I don't think it makes sense to have an aggressive portfolio with something like 70% or more stock exposure. I think you need to be more conservative than that, especially given the fact that U.S. stocks at least look pretty expensive right now on a variety of metrics. So think about your allocation and the situation that you're in. Again, I'm not going to be so rigid as to say that everyone who's going to retire this year or next year has to have the same allocation. It depends on your situation. But if you really need your nest egg to work very hard for you and generate a lot of the income you'll need in retirement, I think you need to be careful about being too aggressively invested. So that's it for today. One last item, speaking of Morningstar, we will have John Reckenthaler on next week. John wrote an article recently discussing many of the policy changes the Trump administration is trying to engineer and how that will affect investors. I think it was surprising for me as a Morningstar alumnus to see someone from Morningstar write an article in that vein saying that the political situation has possibly changed things for investors. So look forward to that interview next week. Right now, this is John Komarianos for Capital Considered signing off. Thank you for watching. Please click like and subscribe if you like our content. Thank you.